But let's invite another guest now. Ashok Wadhwa, the Group CEO of Ambit, joins us now. They do have a conference in Singapore on the 19th and 20th of this month, so we'll chat about that as well. Ashok, hi, good morning. Happy Diwali to you, and thank you for joining us on the show. I wanted to start by asking you about your view on the NBFC space, because we were just speaking to KK Mistry a while back, and he did indicate that the worst of the crisis seems to be over now. CPs are getting rolled over, etc. Would you exude the same confidence?
So I would say certainly that I'm glad I'm talking to you on the subject on November the 15th and around that versus a month ago or perhaps 45 days ago. Clearly, a month ago the situation looked rather grim. There were concerns, and concerns really emanating from whether companies would be able to roll over and meet their commitments. I guess, sitting here on November the 15th, situation seems to be far more comfortable. I think there is general belief that any significant default that we may have anticipated and which was really hurting the sentiment is unlikely to happen, has not happened, is unlikely to happen. Equally, I think between the government, SBI and some of the public sector banks, the fact that they have stepped up to buy portfolios out of SME lending as well as housing finance companies help the liquidity to begin with. I would say the situation is certainly easing, but I can't tell you that the situation is comfortable enough yet. I think institutions are still holding back, not really prepared to lend. Almost everybody seems to have increased the cost of borrowing or lending, including public sector banks, by 100 to 200 basis points. So I would say that there is a significant opportunity on the asset side. Clearly there is a demand, and a lot more assets can be put on the balance sheet. But the liquidity side and the liability side of the franchises are still being tested at this point of time. I'd like to believe that if the current situation continues, there are no further defaults, banks will feel more comfortable, and perhaps in the new calendar year you will see a significantly better, more comfortable situation. So I would say no scare for present, but I'd like to wait and watch for another month to see how the liquidity fully eases up.
Okay, good to hear that, Ashok. Can we forget about then contagion and stuff like that?
I would think so. I would think, the concerns that we heard, is this India's 1997 or Asia's 1997? Is this
Rock was
something like the Lehman of India? Yeah, as we sit here today, I think those concerns can be considered as part of our past. I'm not terribly concerned about any of those dangers at this point of time.
Okay, now let's come to growth itself. The NBFCs were doing a lot of lending, and then now that a little bit of that will not be there, though banks may take over the mantle. We've also heard some kind of slowdown language being spoken by automakers, air condition makers, even tractor makers yesterday. Is the second half looking a little difficult in terms of growth compared to what you expected?
I would say yes. I would say yes. As we approach the end of the first half, I would have said that demand is holding up very well. Corporate earnings were showing strong indications of a very strong year, and therefore I would have said the GDP growth numbers are likely to be quite bullish. But at the end of the first half, as we get into the second half, or as we got into the second half, clearly the meltdown in the NBFC space. Let's not forget that NBFCs have and will continue to play a very important role. Yes, we have public sector banks. The stress in the public sector institutions is getting addressed, but will be a little while before they get to their bullish best. And NBFCs had stepped in very nicely, both in terms of flexibility and their reach. The fact that NBFCs are now hesitant to put more assets on the books, largely driven by the liquidity situation, effectively means that there is less credit available. And I would like to believe that beginning with two-wheelers, then going upwards, it is going to have an impact on demand in the second half. I would therefore believe that both corporate earnings as well as GDP growth for the second half will be a little more muted than one would have thought towards the end of the first half.
So So when you say little more muted, could you quantify that, Ashok? Because, you know, last week we had CLSA come out with their expectations for earnings this year, and they've scaled it down rapidly from 20% plus at the start of the year to about 10% now. Are we looking at, you know, high single digit or even low double digit earnings growth this year and next?
Now, I would like to believe that on an overall basis, on a 12-month basis, on the financial year basis, we will still see a strong growth in corporate earnings. I would believe it'll be in the early to middle teens. But you know, there was a possibility at one stage that we could have been looking towards high upper teens. So again, a little difficult to predict yet, because remember, we are only in November. Diwali has been reported as a good growth Diwali by almost all organizations and all institutions. We need to see what happens between now and December. It is quite possible, as Mr. Mistry said earlier today, that if the situation continues to ease and NBFCs get more funding, as banks become easier to lend to the NBFCs, as interest rates settle down at more acceptable numbers, I would think that there's a big opportunity to put a lot of assets on the balance sheet in the last quarter of the financial year. So I would want to wait and watch before I say how the year shapes up. I would like to see what happens in January and early February.
Ahead of your Singapore conference, what are FIIs telling you? Are they re-looking at India? I mean, we actually saw positive flows in equity and debt in more days in the last 1 week than we have seen for the past several months.
You know, I think we went through a period, I would say, perhaps starting from April and then certainly more intense in August, September, and perhaps early October, where largely because of currency devaluation, and then of course followed by the challenges in the NBFC and the liquidity space, FIIs withdrew a lot of money. They were net sellers in this period for almost every month. One has seen that trend change from early October, and you can see through middle of November that FIIs have become net buyers. I think the sentiment has changed for the positive. I'd like to believe that the fact that there has been a one-time big devaluation in dollar perhaps gives comfort to FIIs that, you know, whatever had to happen on the currency side is being fully baked into the price today. I'd also like to believe that with the correction, particularly in the mid-cap space, there have been sharp corrections in the last 3 months. I'd like to believe that FIIs are starting to look at the mid-cap space more positively. Overall, I would like to believe that, you know, getting into November and then from November going into December, we are seeing a change in sentiment. We are seeing FIIs more inclined towards buying. There are more inquiries towards, you know, stock-specific, you know, opportunities here. So as we go into our Singapore conference, and you know, this has all been nicely kind of reflected in our audience in the Singapore conference, both in terms of corporates wanting to participate in the conference. We've had the best lineup ever this year, but equally in terms of the number of FIIs that are flowing in from different parts of the world to attend this conference in Singapore. To me, all of this is a clear indication of the sentiment that I just shared, which is that I think the larger FII community is starting to become more positive on both the currency as well as the Indian stock market.
So, okay, so the FII community is becoming more positive, but what's your own view on the Indian markets now? You think the worst of the market fall is behind us, and are we headed upwards, or do you think, you know, potential hurdles like elections, etc., could dampen the spirits?
You know, elections are unpredictable anywhere in the world, and you know, general statistics will tell you that in an election year, markets tend to be more volatile and unpredictable than otherwise. We have not just one but two sets of elections round the corner. We have, of course, the state elections in December, and then, you know, to some extent, depending on the outcome of those state elections, people's determination of what will happen in the general elections in the earlier part of the next calendar year. I would say elections can can generally cause volatility and disturb the sentiment. But barring that for a minute, because that's a universal fact, it doesn't matter whether it is India or the United States, but barring that universal fact, I would think that from here, the markets seem to be moving towards a more positive zone. Very difficult to predict given the number of circumstances and situations that have an impact on a market at this point of time. You know, there are things happening in the United States, there are things happening outside of India on which we have absolutely no control. And we do know that many of these things, you know, many of these events do directly impact the market here. So I would say I would be cautiously bullish at this point of time, and I would wait and watch to see what happens in elections. You know, a unpredictable response in the election could certainly have a more dampening impact on the market.
All right, Ashok Wadhwa, we'll leave it at that. Thank you very much for joining us. Take your point that there are reasons to be bullish. I mean, if the markets have put behind an $86 per barrel crude, and they have put behind what looked like a contagion effect in the debt market, in spite of all that, if the markets have bounced back, then perhaps the worst is definitely over for the markets. That seems to be the verdict from our experts as well who have joined on the show today. We'll take a break on that positive note.